Tips for vision in visibility study for a project planning for mushroom production. So here we are going to do the financial study for a mushroom project, for a revision for the stages, for one of the stages and most important stages, which is the financial study. So to start with this, we need to look for the demand forecasting and the numbers of units that we're going to demand. So we're going to demand to estimate for the demand using the average consumption per capita. So this is one of the techniques that we tackled before, but I need to emphasize that after we do the demand forecasting using the ACP and you determine the new population and the growth rate, you need to focus if the new demand, let's say that you plan for it, is more or less for the capacity that you are having. So this is our two important points that you need to focus on it when you are doing to make the computations of the planning. So let's start if the new demand, the demand, let's say, for example, exceeds the capacity. So let's say the capacity is 10 and the market in need in 20. So pay attention that you are going to start your calculation with a 10. If we have a demand for 10 and your capacity is 20, so pay attention that you're going to work with the 10 because this is the need, because you need to customize your production according to the market need and according to the numbers of units that the people are going to buy it, assuming that we have a 3 scenario. And in this project, we assume that it is risky. Since it is risky, you're quite sure that we're going to make 3 scenarios: best case, average, and the worst. So the best case is 25%, the average is 50%, and the last one is at the 100%. This is in case of risky. If it is not risky, then you know that it is a 60%, and then it is 80%, and then finally it's at the 100% to look for the profitability of this project. So this is one of the things that I need to revise it with you as well. We go for the second stage, which is the product mix. And the product mix or the service mix that you are going to investigate for, that if this product have different types or not, different sizes, different weights, and so on. So assume that I have a product A, and according to a market survey or the market need, either by secondary or primary data, that the first product is 60% and the second product is 40%. So this will be my product mix. Maybe you have the 3 types, 4 types, as we did before, but this is the starting point for the financial study. You need to look for the units demanded. So let's start our journey for calculating the financial study. So the first stage here, as you see, that we are going to look for the number of population that we have it in a certain location that we're going to target for it. So as you see here, you will find the first point is the number of population, and the number of population is 523,712. And the percentage of the target that only are targeting 2%. So this is the target population, and this is the one that you are going to see down when you multiply the 2%. When you multiply the 2% times the target population, so this is the target that you're looking for. So, and you have a competitors, and his capacity is more than 7,000. And this is one of the most important point, which is the growth rate of this industry, which is at 20%. So since we have a new population and the population is growing, so when we calculate the growth of this population according to the target, then you will find it the 10,474 times 1 plus 20%. Then will be the new population in the new place that you're going to start. Assuming that this product is under average consumption per capita 1 unit, it is given. So the new demand will be the 12,569. So again, if you look for the demand forecasting, we are going to use this number, which is the 12,000, this 12,000, and put it at the best case scenario. And then I'm going to start the production. So I have a product A 60%, product B 40%. This product is risky as it is given here. So it is 25 in the worst case scenario and 50% on the average, and then 100% on the best case scenario. So here, this is the important point that I wrote it for you in order not to forget the comparison. If the corporate require, for example, here in your case, 20,000 units, or they have a person business to business that is looking for your product, and this is a 20,000. So this is the corporate requirement. So as you can see that the corporate require 20K, but unfortunately I have the capacity of 12K per 1,000 units. So for sure I will make my calculation according to the 12K. If the capacity here is 20K, then and you have the production capacity 20, so they are going to work with the 20. So the first stage is to do the demand forecasting, and this is the important point, because if I make inaccurate calculation for the demand, the rest of the case it will not be accurate. So we did the demand by splitting the 3 scenarios in order to see if this project under the best or average or worst is working or not. Then we go to the fixed assets. Let's say that I assume all the items needed for starting the machines, the equipments, the assets. It's, let's say, after I sum them, don't forget to sum all the equipments together and pay attention. We didn't put any rent in the fixed assets. So here we're going to make the sum of all the machines, the equipments, the assets, and it is a very simple project that it needs only 10,000. So this is the sum. Pay attention, no rent is going to be included in the fixed asset. So I'm going to give you a percentage of depreciation, and the percentage of depreciating the asset, let's say for example, is 15%. So I multiplied the 15% times the 10,000. So this will give me the value that, as you see it here, 15% of the 10,000. So this is the value of depreciation. It is better to do the fixed assets in the beginning in order to know how much numbers of percentage, not to forget it at the end. Depreciation, we're going to use it later in the income statement and as well in the balance sheet when we calculate all the demand forecast. So what is this amortization? My product here, it is a mushroom project, so there is no branding, there is no know-how here, but if I have a brand, there must be a depreciating in its terms of amortization for the goodwill and all the items that we have it here. But in this project, we don't have it. But if I have it, it can be calculated by a certain percentage from the pre-opening expenses, which is the starting of the project. But in this project, since it is not branded, it is a very simple project, there is no amortization here. So we did the second step, which is the fixed assets, all the equipment and machine. Then we proceed for the pre-opening, the license, the paperwork, the know-how, the training, the preparations of all the project starting point. Let's say it's all what they need, it is 20,000. Let's go for the direct labor, and the direct labor here I have one labor to monitor the production and monitor the behavior, and I have one driver who's going to deliver the products here. Each one is take 2,500 per month. So if we multiply the 2,500 times, and this is also a very simplified calculation. So you have the total number of direct labor working in this place is 2, and then you have each one of them is taking 2,500, and they are working for a 12-month. So after you multiply this, you will find that the total will be 60K. So the 60,000 K for the direct labor. Here I need to add the social securities because it's a formal activity. I will make license for it and I establish it in a legal part. So I will add only 40% from this 60K. Then it will give me the amount of the total social securities, and then the total I'm going to add it with the amount of 60K. So here I will have only 24K as a social securities. In some other project, people are giving incentives, but in this one, we didn't put any incentives. So maybe you have incentives, or maybe you do not. It is variable. It depends on the type of project that you're going to have. So we prepared the direct labor, we prepared the room, the production, the fixed assets. Let's go the second step, which is the easiest one, which is the prices. So I will return back here to the demand. So this table is depending on the demand forecasting. So don't forget to multiply the unit times the price per each unit. Then you will give us the amount of sales that you are going to have. Since we are not having the full capacity here, but we will have the 60% only for the product A, 40% for product B, and so on. So this is just for you for the calculation. Usually when we are planning only for the full capacity, will give me the total amount for the best case scenario. So after that, after we did the sales, we are going to look for the raw material. For sure, the raw material, the raw material will be lower than the cost per unit will be lower than the sales that you have it here. So as you see in the previous part, if you look for the sales, it will be more than this 50,000. But if we go back, you will find that sales of 163. The prices is 10 and the other unit is price of 15. So it is price times unit. If you go for the raw material it will be lowered, and you see here it is 50,000. One of the most important items that you need to focus upon it is the COGS, cost of goods sold for production, and this COGS is basically a summation of the raw material plus the direct labor, and this is more important because usually we need to know how much of COGS in the best case scenario and how much of amount of money you needed. So it will be the summation of raw material in addition to the direct labor that we have. We finish with the main important item. We go for the easiest part, which is the overhead expenses. And the overhead expenses I have here indirect salaries. We are responsible about marketing, responsible about maintenance, responsible about other types of cost, which is very important here. So pay attention here, the indirect cost, it is constant here. And we will have utilities, but this utilities as well here is variable. It's very important. So some of the items can be fixed and some of the items can be variable because it is related to the production. Here we put the rent and insurance. In this project, we don't have rent. In this project, we don't have insurance, but we have rent. In other project, as we did it before, you had rent and insurance. So read well the case, because the case here, or read well the assumption that you have it in order to know if you have a rent and insurance or not. Here we put a contingency for the risk, as you see, and it is a fixed amount. And then we go for the depreciation and amortization. Here in this case, we don't have depreciation, amortization. Maybe in other cases, and for sure, if the project is branded, then you will have an amortization. This is the most important part, which is the overhead expenses, because by having this amount of overhead expenses, we can make the calculation for the total project, total investment. So after that, this project required account receivable. So the account receivable, one of the most important items, because the account receivable means that I'm giving the people the product, I'm not calculating all of it as cash. So for simplicity, the average collection period here is 1 month for this project. And usually the account receivable, we are having it receivable. We are calculating it based on average sales. So since we have the average sales, by taking all the sales divided by 12, and I have 1 month, so I can get that average collection period by 1 month, and then I have the average sales, so it will be the 13,660. How we calculate this? So we know that the ACP, average collection period, it is the account receivable times average sales. So here I have 1 and I need the account receivable, which is unknown, times the average sales. So this will be a very direct substitution, sales. So I will just calculate the ACP, the account receivable from the ACP account receivable. So it will be like this. So it will be equal exactly 1 divided the average sales. Okay, so this is simply the amounts that we have. Average collection period, ACP, it is account receivable divided by the average sales. So account receivable divided by the average sales. So it is divided, then it will be account receivable times the average sales simply. So you will have the account receivable. So it will be easily by doing it average sales directly if it is 1 month. And if we look for the inventory of raw material, the inventory of raw material, it will be as well the raw material divided the coefficient raw material divided coefficient. Okay. And the inventory of finished goods, it's depend on either operational or COGS. So inventory of raw material, it can be by, like I calculated by the most important items here. I have to look for the coefficient, and the coefficient how many number of times. And here I can calculate the inventory of finished by looking for the COGS, let's say cost of goods sold divided the coefficient, and then we look for the raw material, how we can look for the inventory of raw material. So inventory, it can be calculated from the raw material divided the coefficient. In this project, we are not buying anything on credit, so there is no accounts payable in this case. After we find the working capital, which is 33,000, we can go to the following step, which is determining the total investment. We have machines with assets and fixed assets is 10,000, pre-opening expenses 20,000, working capital 33, so the total project is worth 63,071 Egyptian pound. So if I don't have that much of capital and I need part of my capital structure by loan, so I will take a loan by 30, or I'm looking for someone to support me financial by 30,000. But let's say that I'm going to take the 30,000 from the bank where the government is supporting many of SMEs. So the 30,000 after based on 13% interest rate, 13% interest rate. So this will be my interest rate 13%, and then which is represent 13% from the 30,000. This will give 4,500. Here, after I calculate the payment or the installment, and the installment, it is easily and it is usually be given. So the installment usually it is a constant amount through the 3 numbers of years. Not 3 scenarios, it's 3 numbers of years. So this is an installment is a constant across the three years I'm going to pay back. So I start by the beginning. This is the installment and this is the interest. So how much of the principal I paid, as you know, that this principal represent the installment, which is the payment that I did it minus the interest that I have. So I have principal. For sure, I can ask about the second principal, the third principal, and all these things. So it is important to calculate it well. So how much we can find the end of loan? So the end of loan will be equal the beginning minus what I paid, which is the principal. It's important to focus on the loan amortization, because this is how can I pay back the loan. So don't forget the installment here, because this will be included inside my pro forma income statement. So we did pro forma income statement. We start by the sales that we received from the each unit sold that we calculated, which is the first point. And then we're going to subtract the COGS, which is the raw material minus direct labor. And this will give me the gross profit. Here, it's important to see that the gross profit, it is amount of unit, which is not that much, because if you see here, when we subtract from it, the overhead expenses, it will give me 7,508. And if we took a loan by this approach, you will find that this loan or this installment and the payment that we're going to pay, it will end up by a non-profitable project. So if I have a higher sale, then this project that can be profitable. If I increase the number of units, it can be having a higher return. So finishing the pro forma income statement, we go for the pro forma balance sheet to see the financial position. The loan, which put me on a higher pressure because of an installment, and the equity here, it says my assets and the amount of capital that I have it. The summation of each one of them would give me total liability on stockholder on equity 63,000. The cash and account receivable that we prepared for this project will be giving me total current asset 53,000. The net fixed asset, which is the 10,000 minus the 1,500, 8,500. So here we find that the total assets is less than the total liability and equity, and it can be covered with the total liability and equity. So it's very important to know that this will reflect on excess of cash and amount of cash that you can have it in order to manage your businesses or activity. So maybe if we decrease this amount of money, which is the difference between both of them, it can ease the burden on the loan, or maybe we can find another means for financing my project by higher capital will give me a more profitable. So this project, if you start by loan, it will not be a good project. So if we look for the net profit margin, it will be -3. If we look for the return on assets, so I don't have net income here, but if I divide the net income in the other case, divided by the 10,000, then it will give me the return on assets. If we look for the net income and divided by the total equity that you finance your project, give you the return on equity. If we want to know how much numbers of years you want to cover your initial investment, all the investment that you are putting here, the 63,071 divided by the net income give you the number of years. So here you can cover and did all the financial ratios, and pay attention for the financial ratio by calculating the amortization, putting the rent in its proper way, calculating the net profit margin and the payback period. Thank you for watching, and which this can be useful tips for you in your doing your financial study in the feasibility study. Thank you.